talk about Infosys first very quickly, because we're going to speak with Trip Chaudhary in just a few minutes from now. The Infosys ADR was down nearly 6%. And this is despite, on the face of it, numbers being okay, commentary being good. So in line. But why is it down 6%? Let me start exactly with that before I get to the details of the numbers. And of course, you will today see a whole range of views coming in. Bernstein, for example, is quite gung-ho about Infosys. Some others are not. So we leave it to you. But we're just telling you why we think the ADR is down. First of all, in-line numbers have come after third-party revenue. And that's the reason, because third-party revenue means that's a squeeze on profitability. So excluding that, numbers maybe not looking that great. Third quarter saw a 20 basis point benefit to revenue from acquisition of Intech. So if you remove that, maybe it's a slightly different picture. Street may be taking that into consideration this morning. Quarter four is to be weak even on an upgraded guidance, and you're seeing the same situation with HCL Tech. I'm not saying the reaction will be as sharp as HCL Tech. I'm not sure. It could be, could not be. But the quarter four number in HCL Tech was the problem, and this could be a problem for Infosys as well, because the guidance post that looks okay. Revenue outlook for quarter four is muted compared to peers. Top 5 and top 10 client contributions have fallen, and then the question is this a sign of client spend slowing down, even though they're saying that discretionary spends will improve? Like I said, overall commentary is great, but they're also saying that they're not seeing significant deals in Q4. Now, let me just quickly come to the numbers for you. Revenue was up 1.9% in this quarter. EBIT was up 3%, margins at 21.3 versus 21.1%, so you see pretty much flat. Net profit was up 4.6% at 6,806. They have guided for FY25 a revenue growth of 4.5 to 5% in constant currency. This is higher than the expectation of 4 to 4.5%. Operating margins of 20 to 22%. And we'll, of course, get a detailed view for you on what Infosys what you make of it with that conversation in a few minutes from now. But let me quickly go through the main numbers coming in, because while the operating margin is good, the overall view for Infosys is a thumbs down. So let's not get confused there with what you're seeing on screen. Axis Bank, meanwhile, is a thumbs down. Operationally, numbers are in line, miss on growth and slippages. What's worked for them is net interest income is in line, operating profit and PAT is in line, NPA ratios are steady. What's not worked is slippages and provisioning. That's elevated, growth is absent. There is a decline in net interest margins. In fact, net interest income is at 13,606 crores versus 12,532 crores year on year. That's up 9% year on year, but 1% quarter on quarter. Net interest income at 13606. That's slightly, I would say, in line with NDTV Profit estimates. Operating profit at 10,534. That's up 15% year on year, but down 2% quarter on quarter. Operating profit at 10,534 crores versus the NDTV Profit estimates of 10,500 crores. Provisions at 2,156 crores, which is down 2% Q on Q. And provisions are at 2,156. Our estimates were 2,000 crores. PAT at 6,304, up 4% year on year, down 9% Q on Q, which is why the thumbs down. I think this is going to be the pain point that you might see. Asset quality as well, slippage ratio at 2.13. Gross NPA ratio at 1.46, slight uptick of 2 basis points. So that's the take on Axis. Let me come to Havells very quickly, my third stop. It's a thumbs down there again, so 3 on 3 with a thumbs down today. Havells India Q3 revenue surges, but net profit has slumped because of higher employee costs. That's gone up about 23%. ECD segment has sustained strong growth, 15% year on year. Margins have been impacted due to deepening R&D aspects of the business. It's the third consecutive quarter where company has missed profits. So you have to look at that as well. And you've seen some destocking. So inventory has come down as well. So those are my top three, Alex, and they don't look too good.
Yeah, absolutely. And in fact, I have a couple of interesting stocks as well. I know that we say 3 stocks, but I've selected more. Bear with me today because I think that this is an interesting talking point. Reliance Industries is what I will start with. And it is a positive set of numbers. It is a thumbs up, in fact, for Reliance Industries because the PAT number, the net profit is ahead of expectations. It's a growth of in double digits, and it has beaten consensus estimates. The margins have expanded on a sequential basis, coming in 18.2% or thereabouts. The revenue has grown about 4%. Now, interesting talking points and what might have shaded the results just a tad bit. You were expecting there to be a little bit of pressure for the O2C business, and that indeed was the case. But they have managed to have an expansion in the profit in the EBITDA margins in that quarter gone by, despite the fact that exports have actually fallen. You've got an improvement in the domestic revenues from O2C, which is seen as a positive. But really, the joker in the back and the reason why you have had a beat seems to be the retail performance. And you have the retail revenue, which has increased as much as 18%. And they have had benefits from the festive season demand and the streamlining in operations that they have undertaken. They've seen an increase in the number of stores that they have had, and also an increase in the footfalls. And finally, Jio. You've had an ARPU, that is average revenue per user, that has gone past the 200 mark for the first time. I'm told that the street was expecting just a tad more, but it's just about a shade more than what came in at 203 or so. So it shouldn't be too much of a negative there. The revenue increase of about 3% sequentially, coming in at 29,300 crore rupees. The impact of the price increases or the tariff increases being seen in the stock or in the performance of Jio. Let's talk about the next set of stocks, because I think this is an interesting one. You know that Tata Sons has been appealing to the Reserve Bank of India to remove its tag as a core investment company, and to that end it has been reducing the amount of debt that it has. The RBI has come out with its list of upper layer NBFCs, and Tata Sons has been included in that list. But it has stated, the Reserve Bank of India, that this is without prejudice to the outcome of the application to deregister the company as a core investment company. But if things stand as they are right now, Tata Sons will have to list come September 2025. And you saw earlier last year a few stocks that currently hold Tata Sons share react to the update. And you had the likes of Tata Chemicals, Tata Motors, Tata Steel, and a few other group companies that all have stake that could react maybe just sentimentally in trade today. So keep that on your radar. The last stock I will talk about is a thumbs down. This is Hatsun Agro. Let me run through very quickly. The revenue has grown about 6.5%, but the EBITDA is flat, and the net profit has come in lower by about a third at 40.9 crore rupees. Seemingly a bit of an issue in terms of the inventories in the quarter that's leading to higher costs. Agam, that's my list.
Right. Well, I'm looking at the LTIM, and I guess it's a miss when it comes to the operational numbers. So when it comes to revenues, we've seen about 2.5% growth sequentially. Its operating margins, that's EBIT margins specifically, have contracted substantially and also below street expectations. Consequently, profit taking a knock of around 13.3%. It does have the highest deal wins, but I'm not sure if that's going to be something which is going to be playing in favor of LTIM. Metro Brands, it's a fairly steady quarter, I'd say, because we're looking at a 11% growth year on year. Its EBITDA margins have expanded but remain mostly steady at around 32%. Net profit, however, taking a knock of around 3.7%. The final one on my radar is Borosil Renewables, where we understand the company's German-based arm, GmbH, will implement a temporary cool down of a furnace, which means that there could be a little bit of slowdown as far as production in Germany is concerned, and that could have a slightly negative impact in the near term for Borosil Renewables.